Hey, I'm on. Hi, I'm Pete Andresen. I am with Andresen and Associates Incorporated. I'm an investment manager, a fee-only investment manager, and I'm here to discuss the quarterly review. I'm doing this YouTube video for my clients. Um, I think that might be backward. Anyway, I wrote a newsletter to accompany your quarterly return, your report, and it was for June 30th, 2021. It is now July 28th. And I wanted to do this as a Zoom call and turn it into a YouTube video so you can see a little bit of explanation about what I think is going on and what I think is going to happen in the future. So let's get started here. I have to add that, we're dealing with an uncertain market. And everything I'm going to say is my best guess, just like everybody has their best guess. And I want to discuss what happened in the first 6 months of this year, 2021, and what's likely to happen in the next 6 months and beyond. As you can see, that 2020 Olympics in Tokyo is going on right now with mixed results, with no spectators. And that kind of says it all. The big thing is we're coming out of COVID. We continue to recover from the COVID catastrophe, and people, it is my theory that it's going to take 5 years or a decade or longer to fully understand how COVID has affected us. It has truly affected the world, society. Its consequences are far-reaching, and they're not all negative, as harsh as that is. The United States is going to end up losing, my guess is something like 650,000. That's basically that's 2 in 100 people dead and disability. But we're also witnessing a miracle in the form of these new vaccines that are revolutionizing the way medicine is done. Meanwhile, we have the stock market boom, bubble, mania, whatever you want to call it. It's rolling on. It's been going on since 2009, pretty much without an interruption. A few short little scares, but nothing big. And we'll take it. I mean, the money's very real. We've doubled, so hell, or more. So let's take it. One bit of news for 2021 is that the small stocks outperformed for the first time, and we're very diversified. Our portfolios right now are very conservative and very diversified. We've been holding on to all those diversifications, you could call them. One of them is small stocks, and finally, we're getting some good returns on that. I'm going to discuss the monopoly money economy and debt creation, both of which represent gigantic experiments in monetary, fiscal, financial theory. We've never tried this before. I want to discuss inflation, how long that's going to last. Valuations, of course, I'm going to get on my horse. The stock market's been overvalued for 5 years, and the Fed has always saved it, and that may be okay if we're in a new paradigm, but it's also very dangerous. We are witnessing a correction in Chinese technology stocks. We'll discuss that. The government expects a near stagnant economy for the next decade, and we got to absorb that as well. We'll review the fact that corrections are normal, and then we'll finish off with a little bit of band. My band will play for diversification, discipline, caution, and courage. Again, we have gone through something awful. This is excess mortality from all causes, not just COVID. 2020 represented a gigantic increase in the death rate. As I said, when this thing's over, 2 out of 100 Americans will be dead. Most of that happened in the first part of 2021 and the back half of 2020. And the implications for society are gigantic. Technology has changed. Families have been broken apart and restructured. Long-term care for seniors has been tossed into the handbasket, basically. Here's 2021, and as you can see, you're seeing the miracle here, which is that despite COVID variant D, excess deaths has diminished to the point of normalcy. We've gone back to the average. And the reason seems to be the vaccines. Apparently, at least in the short term, they're a miracle. 97% effectiveness in preventing hospitalization, even with COVID-D. COVID-D is more transmissible, but apparently no more fatal if you're vaccinated. Yes, you can still get COVID if you're vaccinated. The death rate is way down, no matter how you slice it. Now, of course, some of these deaths took place due to the shutdown, due to depression, due to delayed medical assistance, whatever. But the fact is, the COVID experience has been huge, and we still haven't processed it. But we're in the middle of a miracle. This is my Zoom call, my YouTube video to recreate the June 30th, 2021 quarterly review, and thus a lot of what you're about to see is the graphic representation of what's already on there. If you want a copy, you can contact us here and we can provide that to you. Bottom line, the stock market in the form of the S&P 500 index, we use an index fund, an index mutual fund to represent what you get in the real world, 15.24%. If we all went into hibernation right now and sat out the next 6 months, or slept away the next 6 months, we would really be in a good place. This is a good return for the year. It's above average for a year. If we can hold on to this, it's been a good year. The Dow Jones Industrial Average, which has less tech, did 12.7, still above average, still a good year. But we're getting a warning here in the bond market. Negative 7.61% on the long bond tells us that people are worried about inflation, and they're worried about how do we find our way out of this COVID situation. This is like 1987, which had a similar warning posted by the bond market after a tremendous boom, tremendous overvaluation of the stock market. And there was a correction. Stocks went down. I recall 30% in one day while I was watching. I was just getting started in this business. Bonds went up. And bonds, even though I expect marginal returns in the next 5 years, still perform wonderfully during stock market corrections. So at this point, if we have 1987, I'll take it because it healed. It basically recovered within 2 years and gave us a tremendous opportunity to buy. Some of my clients made fortunes out of that, as did I. This is the 6 months from December 2020. Negative on the bonds. You can see that's T. Rowe Price, negative 2.10% and negative 5% on the gold. Gold only works when doom is expected. When doom is not expected, gold tends to fade. So there's that. Stock market. S&P 500, this time we're using the Schwab index fund. That's what most of us have. Up 15%. Small cap, up 17%. Technology, not as good because tech, given that it's overvalued, is going sideways a little bit. International did quite nicely. And value funds, we own value. It has lagged the S&P 500 because it doesn't have tech in it. And it's done fine. So once again, tremendous 6 months. If we could hibernate for 6 more months, I've got too much going on in life with kids and everything to really want to do that. But this would be a decent return if we can just go sideways now. The big news is what happened in the last year, which was a blowout year. June 2020 to June 2021 was a blowout boom year by any stretch of historical records. 40% on the S&P 500. We all own these index funds. They all did 40%. Small cap did 62%. Our diversification in small caps finally paid off after years of lagging. I'm so happy. Chinese tech, Matthews Asia, innovators, institutional, that would include some Taiwan tech. That would include some Hong Kong tech, which is now emphatically part of China, larger China. It would include some other tech as well, but mostly it's Chinese tech and Taiwanese tech. up 54%, which is absolutely stellar. It beat, in fact, it beat American tech, 46% for American tech. International did 29%, still record-breaking performance. And value funds, as represented by our Oxier fund, did 34%. Boom time for value funds without being overvalued. So they're not as risky as these tech stocks. Now, the down markets were in bonds and in gold. Once again, you need a lagging economy to make bonds more attractive, and you need a premonition of doom to make gold more attractive. Here's the big experiment. This is what we have faced for the past decade since 2008, and now it has gone into overdrive. When 2008 happened, they stimulated a bit and it worked. And when they stopped stimulating, the market went down. So they stimulated more and they stimulated more. When COVID hit, they went to the pedal went to the floor. Basically 35 or 40% of all US dollars in existence have been created since March. In other words, they grew the money supply, not by the printing press, but by pumping digits into the computer. Doesn't seem to be very hard to do. So our money supply spiked at a level never before seen ever in history and humanity. Never seen this before, never. And if this was 1923 Germany, we would see vast inflation encompassing everything from shoes to cars. We're not seeing that because most of this money seems to be going into speculation, burning off in Bitcoin, going into investments or savings. Did it work? Well, we're here. The economy is recovering. The economy is doing great. Will there be consequences? That's where we don't know. We don't know what the consequences will be. There was epic debt creation at the same time. Corporations are awash in debt, not so much the American consumer yet. So give the American consumer some credit for being a little cautious and a little wise, but massive debt creation at these low interest rates is underway. The result, I can't envision how it could happen, but I can't envision how we could have high bond market returns, because the only way we can make capital gains in the bond market is if we go to negative interest rates. The only way we can make excuse me, current cash flow is to increase the interest rate, and that's going to be hard to do. Raise the long-term treasury return right now at 1.93%. At a 5,000 year or near a 5,000 year historic low, going back to the Bible, going back to the Egyptians, going back to the Sumerians. Interest rates weren't that low. They're that low now. Artificially made that way by the Fed's bond buying program. But raise that interest rate to 4, which is historically still below average, way below average, and you get massive defaults. The federal government all of a sudden doubles the cost of borrowing, which creates a budget crisis. The corporations start defaulting and turning their bonds into stock or just going bankrupt. If they turn their bonds into stock, that means that there's sudden supply in the stock market and stocks might go down. Basically, we're kind of stuck here and we don't know how to get out. That's part of the experiment. There's a big argument being made by the Elizabeth Warren Brigade and other governmental people with her. Janet Yellen's one of them, that this doesn't matter because of demographics, because of aging baby boomers. You could create a Japan-like debt experience. Japan, though, topped out its stock market 30 years ago and hasn't recovered yet, really. Do we really want to do that? I don't know that we do. So the experiment continues. It may have a great result if another technological innovation lifts us up. I mean, the electric car could do it. The driverless car could do it. The iPhone did it in the past. I'm doing this on a laptop. That could do it. We have been saved repeatedly in the last 40 years, 30 years, by tech innovation making things cheaper and by outperformance and overproduction. Everything's gotten cheaper. If that were to happen, then things will be fine. We'll just keep low interest rates forever. However, we're still in this big experiment and we don't know what to do. So let's assume we're marching forward with a great ball of debt, like a dung beetle in front of us. We're dung beetle investors pushing this giant ball of debt. What is debt going to mean? It depends on what you do with it. If you invest it in things like education and you invest it wisely, whatever that means, that's what the big debate on infrastructure is about. What are the returns going to be? That's why everyone's pushing back and forth. As you might imagine, some people in government have redefined infrastructure to mean all kinds of different things. Education usually, I mean, real education, not just buying ivory towers, but really creating more learning among our young people and among displaced workers, really historically has delivered the best results. So as the GI Bill in World War II showed us. But if you don't do that, if you just flush money, it produces nothing and it spreads costs into the future. The Biden administration is currently apparently implying that it's going to be a relatively flat economy so that we're going to have to absorb the costs spread into the future by our debt creation. Inflation. These are used cars. This is created by the Manheim Corporation. It's their used vehicle value index. So right about here, COVID shut down, prices fell, but they stopped making chips, computer chips, which are essential in the creation of cars nowadays. The result has been that new cars are slow to come online. There's a shortage of them. We're about to see that manifest in other aspects of technology as well. And the result of that was, since you couldn't get a new car, you bought a used car as we came out of the shutdown. And the result has been a giant spike. That has contributed to, and this kind of experience is contributing to our spike in inflation. If you've ever tried to rent a car in Hawaii, I was going to go to Hawaii with my family. I canceled the trip because I couldn't pay $5,000 for 5 days of renting a car. Because there's a shortage of rental cars, because the rental car agencies sold them because of this boom, possibly wisely. I mean, can't say that this is long lasting. What's likely to happen is that chips will get made, cars will get built, supply will increase because this is a major profit opportunity for the car manufacturers. This is a major, I mean, people are willing to pay premiums. So sell those cars, this price will drop and inflation will drop with it. The same with energy. The same with lumber. As we get back into production, we'll get there. Meanwhile, it's bad. Now, if inflation becomes more than a 2 or 3 year experience, we've got other issues, especially in the bond market, which is going to have to be repriced. At that point, we would see regime change because inflation always creates recession. It always creates a government transition because people throw out whoever creates the recession. So you're listening to the media and they're saying that this government is here to stay. It is not. Valuations. Now I keep beating this particular drum. I beat a lot of drums, but I beat this one a lot. As you can see, here's the average of valuations, and we have been overvalued here for a while. Let's just say that this is the new average because of technology. Still, we've been overvalued a lot. And obviously, this is implying that we've reached a new paradigm of valuation because of technology stocks. And that may be true. You know, things do change. However, the implication is that, as you can see, it does decline back down to historic levels. So more overvalued is still not a good thing, and less overvalued is still a good thing. At this point, by all yardsticks, we are overvalued in the stock market. And this may go on for years because of the Federal Reserve stimulating and the fiscal policy of the United States government. This thing could boom. And as I said, Another technological miracle may rescue us yet again. Watch for one of those in healthcare. And that's not necessarily going to be a good thing, because if we can use the technology from the COVID vaccines towards cancer, all of a sudden, let's extend the lifespan of the average American by 3 years. All of a sudden, you're looking at all kinds of pension issues, Social Security issues, all kinds of issues. So anything is not necessarily an unvarnished good thing, but I'll take 3 extra years of life. I'll just save extra hard, just like you and me. We're seeing a correction in Chinese tech stocks. This may be caused by the Chinese government interfering, or it may be a necessary action on the part of the Chinese government to prevent monopolistic power from arising. It could be that we need a little of this in the United States. The Chinese economy is a managed communist. Well, it's not communist, it's fake. It's an oligopoly. It's more like a managed top-down economy. Communism is something they say for virtue signaling reasons. Realistically, it's run by the mafia. And sometimes it's a benign mafia and sometimes it's not. Their basic concept is that 50% of the Chinese population is too stupid to vote. And our giant experiment of the 21st century is that they may be right. It could be that 50% of the American population is too stupid to vote. We will find out, depending on what China does next and does in the next 50 years. At this point, unless their debt bomb, they've got a debt bomb too, just like we do, unless their debt bomb blows up, they're growing quite nicely and taking away American market share hand over fist. And we're letting it happen because we're diverted by other things, other social issues. Meanwhile, their tech stocks are pretty good companies. And although their accounting is opaque, we can't be sure what's really going on in there. They have been very profitable. So we own these in the Matthews Asia Technology Innovators Fund. We will be looking forward to a loss in that fund in the coming 6 months, unless something reverses. And if it gets bad enough, we will buy more of that fund. My keep awake at night scenario, which was expressed in my novel that I published this year called The Pyre, which is how I handle my insomnia. I write. Anyway, that includes a war with China, even if that war is pretty much confined to the internet. If that happens, we are in a bad place. More likely, we will all muddle by. I worry that China is essentially 1930s Germany with all of its expansionistic tendencies, but it still may not come to pass. Most of the time, it seems that we all muddle by, and that may happen here too. So I will continue to invest a small portion of our money in Asian tech stocks. The economy. Straight from the White House via the Wall Street Journal. Everybody's talking about wonderful times ahead, and they're right for the next 3 years. 2021, 2022, 2023 all incorporate a boom cycle created by that excessive debt and our recovery from COVID. As we absorb the COVID experience, which is going to have all kinds of ramifications socially, politically, we can't begin to guess. But later on, according to the current administration, the economy flattens out and actually goes kind of what? Somnolent. It becomes a stagnant economy in a lot of ways as we deal with the consequence of all of our debt creation. This may be necessary. As I'll discuss later, our financial markets and our economy tends to go through up cycles and stagnant cycles, and we may be entering a stagnant cycle, in which case our diversification is going to pay off big time because we'll buy and make money from this experience. Long-term periods of boom and bust. This is from 1909 to 1921. There's 8 periods of good and bad cycles in the stock market. And we've had a wonderful run here. wonderful, wonderful, wonderful run from about 2008, coming off the lows of 2008. And at some point, we will have a correction. Now, I believe that will be temporary because, as you can see, looking back in history, all corrections have been temporary. Even if governments change, if you look at the French stock market or the Japanese stock market or the stock markets in Russia, people manage to make money even when governments themselves change or the geographic boundaries of the United States change, and the stock market still goes through booms and busts because innovators are always out there and we always invest in them. So let's say we have a downturn. First of all, we don't know when we're going to have a downturn because the Fed's going to do everything, including mortgaging its vital organs, to keep that from happening. They're going to keep stimulating. They're only going to stop stimulating when inflation becomes embedded or they run out of debt capacity. When that happens, there will be a correction and it will be temporary and we will be buying. At this point, let's say it goes negative 45% back to the annual normal pace. That implies it'll go a little beyond that because, as you can see, corrections usually drop below the average. So let's say we're looking at a potential 50% correction, which we will survive just like we survived the 50% correction in 2008. And that's why we're cautious. We don't know when that's going to happen. It could not happen for another decade. History tells us we won't be that lucky. I would point out, though, that we have corrections all the time off the highs. I mean, they're normal. Stepping back from a high is a normal part of the price determining process of markets. So, as you can see, this is from 2010. As you can see, corrections are, especially corrections of less than 10%, are normal. Media routinely blows them up into something horrific and big. We don't have to do that. If it's horrific and big, you're diversified, you're conservative, we will buy. We're good. So what are we going to do going forward? We're going to stay conservative and diversified, but not excessively. We're not going to buy garbage and we're not going to get too cautious. Most of us are at 40 or 50% or 60% or 70% stock. All of that, depending on your risk tolerance, is doable. The Fed can keep this bubble inflated for years or not. If we are in a new paradigm, as Janet Yellen and Elizabeth Warren and others suggest, they might be right. It could be that the aging baby boomers have created a situation where we can do a Japanese style experiment and create debt as a percentage of GDP, gross domestic product, as far as the eye can see, and nobody will care. History tells us probably not. Japan was not helped by going deeply into debt. They're just doing that debt creation now so the current government can stay in power, but they're doomed. So emphatically, this thing could stop, and it could stop quick. And that discovery could be temporarily rough while they recalibrate. That's that correction I'm talking about. So onward we go. The bond market, I don't expect much from the bond market in the next 5 years. Some miraculous event may prove me wrong. We're holding bonds just as a ballast for the coming stock market correction. Meanwhile, I expect 1%, 2%, 3% in bonds, 4% if it's a big deal. If we're buying junk, which is supported by the Federal Reserve right now, junk bonds can't be paid back unless the company keeps growing. They're going to get hammered if we have a correction in the economy. If we have a recession, they're going to get pounded unless the Fed supports them like they did in 2020. So we'll keep a reasonable allocation there. We're going to let our asset allocation funds like Wellesley, our income builders, they're going to own our long bonds because they can maneuver around and find bargains better than we can. We already have a gentle bias towards international value, small, and healthcare. Those have underperformed the S&P 500 because they aren't tech. Tech has been the obsession of the stock markets for the last 5 or 6 years. It's grotesquely overvalued. It's going to reach the end of its leash at some point. We will buy it on weakness. We don't need to buy any more right now until it's weaker, as we will with the Chinese or Asian technology stocks if they become a really attractive bargain. We need to watch out for excess and misdirection from media or government. We have to watch out for excessive buildups in these bubbles, and we have to watch out for media misdirection and social misdirection and political chaos. Basically, turning off the box is going to be a big survival mechanism for the next 6 months. But it could be good. All we have to do is go sideways for 6 months, and we've locked in a very good year. Most of all, and I'm going to rehearse this again and again in my own mind, the next decade is going to be gigantically tumultuous. We already know that. We're all going to deal with social issues, political issues, technological issues, business, work. Our work habits have been upended by COVID and technology. If you're looking at the rent in San Francisco, rents are going down because people are moving out because they can work remotely. So the world is changing a lot and is going to keep going through the next decade. During that time, China is going to decide if it's going to be a bully or not. So stay tuned. We need to invest with this in mind. Take care. The flowers are still blooming out there. The sun is still rising. Let's enjoy the rest of our summer. Thank you very much.